Hello, everyone. This is Alan Wang with Alan Wang Realty Group at Keller, Santa Clara Valley. Really excited to bring you the Q1 2023 real estate update. And without further ado, let's get started. Well, first off, there are multiple economic factors in flux as always. The big question that's been coming up a lot is what is the impact of the failure of Silicon Valley Bank? I will say that the impact is very little. The government has come in and stepped in and guaranteed all funds. Startup companies have made their payrolls and they are still liquid. And so I'm sure those funds have all been moved elsewhere at this point. Silicon Valley Bank, very minimal impact to residential real estate. First Republic Bank was one of the other banks that possibly had some issues or had a bank run happen. A lot of funds have been infused into that bank. Regardless, the good news is that bank does not do a lot of residential loans, and we're not as worried about that bank as well. Inflation continues to trend downward, which we'll cover in detail later, as well as mortgage interest rates. Stock market has actually shown a little recovery since 2022, which is good news. The layoffs, however, are going to make it a turbulent year. State of the market. Remember, May 2022 to about December 2022, the market froze. Buyers were nervous. The sellers got nervous. Everyone was nervous. Everybody just froze. Some deals were happening, but only if there was a good deal happening. 2023 has shaped up to be a completely different year. Buyers realize that life goes on. They're still getting married. Their children are going to school. They need to move into different places, different areas. Divorces, life is still happening. And buyers basically said, okay, great. Well, the rates are what they are. It is what it is. We'll just have to deal with the rate environment. So they've gotten comfortable with it. Inventory was always low. 2022, actually, even though the market was rough, there was still very low inventory. A lot of sellers do not want to move because they have such good interest rates. And so with the new flux of buyers, we're seeing multiple offers again. So multiple offers are back. They're not as aggressive as they were during the COVID years, but multiple offers are back in many areas. There are two markets still, a tale of two markets. The first market is the prime markets. These are the markets that have great schools, great locations close to work, priced properly. These homes are doing well. Folks are still buying these properties and with multiple offers. But again, that overbid's not as high as it used to be, but still multiple offers. There are still some opportunities out there. The second market that we're talking about, market number two, perhaps not in the best school district, maybe not in the best areas, a little further from work. Perhaps these sellers are overpriced the property. These properties are sitting a little bit longer, especially the townhomes and condos are suffering a little bit more than the single family homes. In those areas, you might have some opportunity, but don't wait around for the seller to drop their price to the price point where everyone's okay with moving on. Try to move early and try to get a deal. Now, during the peak of COVID, inflation was at 9.1%. If you remember, I saw gas at $7.80 in Menlo Park, for example. Now gas prices are back down, as one example, to about 6%. And it's good. Definitely, the Federal Reserve is doing their job. Rates are trending in the right direction. But yet we still have a ways to go before we hit 2 to 3%, which is where they want this interest rate to be, inflation rate. The Federal Reserve will continue raising rates, maybe a little slower, until this gets down to the 2 to 3% level. Now, interest rates continue to be fluctuating, but they're stabilizing a little bit. And this chart here is a nationwide rate, 6.32%. But the goal of this is to just show you in the 80s, when your parents were complaining about 18, 19% rates, that was true. And even people bought and sold real estate then. 6.3%, not the worst thing in the world. I know it's more than double what we're used to, but looking at more local rates, this is an important chart for you. Wells Fargo Home Mortgage is a big lender in the Bay Area, Silicon Valley. Most of our homes are not conforming, but the conforming rates will be a bit higher since those are government-based. The jumbo loans, however, are where they have a little bit more flexibility. You will notice there's one discount point, meaning you have to buy down the rate a little bit. So these rates without a point likely hovering around a quarter higher. So let's just say 5.25% to 5% for a 15-year or 30-year fixed loan. Then under the ARMs, you have a 7-year at 5. So let's say without the point, it's 5.25. Again, rates from 5 to 5.5%. It's been hovering around this and actually a little bit lower this year than last year, which is good news for us. There are some assets under management programs, meaning if you bring in cash outside down payment, that could possibly bring down the rates some more. So there are some more friendly programs going on that we could discuss as far as rates are concerned. The NASDAQ, there's some interesting data on the NASDAQ. In 2021, we had an increase of 23% in our stock portfolios. Now, remember, the NASDAQ is where all Silicon Valley workers, majority of tech companies are housed. And this is directly tied to their employee stock purchase plans or their restricted stock units. In 2021, during COVID, they saw a 23% increase in their wealth. And however, in 2022, the market was down 34%. So they were down quite a bit from their original portfolios. Now, as of yesterday, April 2nd here, we have 2023, we have a total of 18% increase. So actually they made back the losses and actually technically are net 7% up right now from the COVID time. So actually that could be another reason why buyers are back out and about again. They're seeing their stock portfolios increase enough so that the down payment is helping their down payments on properties. Unemployment rate in January was 4.1% and is currently at 4.3%. This is very likely due to the layoffs that have been happening, which seemingly are occurring every week. As you can see, quite a bit of folks getting laid off, with a lot in the Silicon Valley, given that it is tech. What I'm hearing out from folks looking for work is that there's certainly a hiring freeze on majority of jobs out there from big companies, and there are quite a bit of candidates applying for the jobs that are open. There are also yet contracting positions available as well. Folks may not be applying there yet, but there are jobs if they need them. We'll have to monitor this Q3, Q4. Remember, tech employees have a long runway, so it could be months before we see an impact, if any. But they definitely could possibly go to consultant route if they wanted to. Projections for the rest of 2023. Banking sector seems stable. Government has shown that they're willing to back the banking sector if there are any more failures, which is a good thing. Inflation trending downward. Hopefully we can get this done by the end of the year, which would be amazing. Federal Reserve, again, will keep raising rates until we get this under control. Maybe in a slower pace, maybe not. Sellers, inventory is still very low, and there is one universal rule. If you price your house properly to what the market will accept, your home will sell. If you happen to own a house in the prime market, where there's a good school district, good location, and you price it right, the house will sell with multiple offers. So that will be for sure. The second market, where perhaps you're not in a good school district, you're not as close to the office per se, you'll see same thing. If you price it right, it will sell. But the big question for you is, are you willing to accept the price the market is giving you, since we're still recovering from last year's dip? If you are, then there's a transaction to be had. If you're holding on a certain number and the market doesn't show it in the data, then you might want to wait. If you are overpriced within 2 weeks, you'll pretty much know if there's no action or activity on the property. But worst case, you can hold the property 30 to 45 days. And if you drop the price to the right number, then you'll know that's the market was not willing to pay you the amount that you were listed for. Once you drop it to the right amount, then that they're willing to pay, the transaction will be made. For buyers, the market is turning. You missed the bottom. I'm sorry. Last year was the year to go. We look like we hit the bottom. We're recovering from last year. But again, you're catching on the way up, which is a good thing. But you might have to compete again against other folks. So the non-contingent offers might be coming back. They're going over list prices. It's coming back. And depending where you are, there are aggressive overbidding going on in some areas as well. Again, my name is Alan Wang with Alan Wang Realty Group at Keller, Williams, Santa Clara Valley. Give me a call, 408-313-4352. That's a direct line to me, or email me at alan@alanwangrealty.com. Every family has their own unique scenarios, and I'd love to sit down and understand them with you. Have an amazing rest of 2023.